The Fed is back in the news again, and the interest rate story isn't moving in the direction most real estate investors were hoping for. Just a few days ago, JP Morgan shifted its expectations and says it now expects the Federal Reserve to raise interest rates by 25 basis points at its September meeting. At that point, futures markets were pricing in roughly a 65% chance of a September hike. Then we got Friday's jobs report, which came in much weaker than expected, and suddenly those expectations completely changed. So now we're back to asking the question, are interest rates actually going up again? And more importantly, if you're a real estate investor, what does that mean for you? Because whether you're buying rentals, flipping houses, investing in commercial real estate, or lending private money, interest rates can have a major impact on the deals that you're looking at. And today I want to break down exactly how I'm thinking about this as a real estate investor. If you're new here, hi, I'm Andrea. I'm a pharmacist working full-time in corporate America, and I invest in real estate through private lending, creative finance, and strategic buy and hold opportunities. This channel is all about helping high-income professionals create financial freedom without needing to quit their job tomorrow. If that's you, hit subscribe so you don't miss a video. So let's start with what's actually happening. At its July meeting, the Fed held its target interest rate range at 3.5% to 3.75%, but that decision was pretty closely divided. 3 members of the committee wanted to raise rates by 1/4 percentage point. Then in August, JP Morgan changed its outlook and said it expected a 25 basis point increase in the September meeting. One of the factors that they highlighted was continued pressure from energy costs and supply chain disruptions, which could keep inflation elevated. Their analysis also pointed to longer-term Treasury yields moving higher, with the 30-year Treasury reaching its highest level since 2007. So at that point, the market was increasingly preparing for a September rate hike. Then Friday happened. The July jobs report came in much weaker than expected, and the probability investors were assigning to a September rate hike dropped significantly. And that's really important because it shows us something. The Fed's next move is still very dependent on the data coming over the next several weeks and months. We have inflation, we have employment, we have energy prices, we have the bond market. All of those things are going to influence what happens next. But as a real estate investor, I'm less interested in trying to predict exactly what the Fed is going to do and when. I'm much more interested in what changing interest rates mean for the deals that I'm actually underwriting. So why should real estate investors care? Well, let's start with one of the most obvious reasons, the cost of borrowing money. When interest rates rise, financing generally becomes more expensive, and that affects almost every part of real estate investment. If you're buying a rental property, a higher mortgage rate means a higher monthly payment. If you're flipping a property, your acquisition financing and holding costs can increase. If you're buying commercial real estate, higher debt costs can have a significant impact on your cash flow and your debt service coverage. If you're refinancing an existing property, the numbers you're looking at today may be very different from the numbers that you originally underwrote. Here's the part that I think is really important. The property itself may not have changed at all. The house is still the same. The neighborhood is still the same. The rent might be the same, but the cost of the money has changed. And that can completely change whether or not a deal works. Higher interest rates can also change what investors are willing to pay. This brings me to another important concept, purchasing power. If the cost of borrowing goes up, buyers generally can't afford to borrow as much while maintaining the same monthly payment, and that can eventually put pressures on property values. This is something I think about when I'm underwriting private money loans. When I'm evaluating a property, one of the things I care about is the property's after repair value, or ARV. And when interest rates are higher, I become more conservative with my ARV assessment. Why? Because I don't want to look at what a property might have sold for in a completely different interest rate environment and assume that number automatically applies today. If buyers are facing higher mortgage payments, their purchasing power may be lower. That can affect the price they're willing or able to pay for a property. So if I'm lending money based on future value of that property, or at least considering future value of that property, I always want to be lending on as is. I want to build some additional margin of safety into my assumptions. It's a really important distinction when you're looking at private lending. You're not asking, what is this property worth? You're also asking, what is this property reasonably likely to be worth when my borrower needs to sell or refinance? And the interest rate environment is part of that equation. So what does this mean for real estate investors? Like, what happens if rates stay higher for longer? I think there are 3 major implications for real estate investors. Number 1, some deals simply won't work. You might have a property that looks great at one interest rate and doesn't look great or doesn't work at all at another, and that's okay. The answer may simply be to pass on the deal. Number 2, sellers may become more flexible. We've already seen this happen in some markets, but if buyers are having a harder time getting deals to work, sellers may eventually have to become more creative. That could mean they could lower their prices, they could offer seller financing, they could do interest rate buy downs, seller concessions, different terms, or some other creative structure. And this is one reason I think creative financing becomes particularly interested in higher rate environments. When traditional financing becomes more expensive, the structure of the transaction can become much more important. And number 3, competition can change. When the money gets more expensive, some investors will just sit on the sidelines, and that can create opportunities for investors who have access to capital and who know how to underwrite deals conservatively. This is also one of the reasons I've become particularly interested in shorter-term private money loans. I'm talking 6 to 12 months. When I'm lending on a real estate project, I'm generally much more interested in 6 to 12 month time horizon than locking myself into a long-term investment based on assumptions about where interest rates and the real estate market are going to be several years from now. Here's why. Let's say I make a private money loan today. I underwrite the property based on the information I have today. I look at the current market. I look at comparable sales. I look at the borrower's renovation plan. I look at the expected ARV. I look at loan to value, and I look at the exit strategy. Then 6 to 12 months later, I get my capital back. At that point, I can reassess the environment. What are the interest rates? What is the Fed doing? What are the assumptions that I previously made on deals that have changed? What are mortgage rates? What's happening with home prices? What are buyers actually paying right now? How quickly are properties selling? And then I can make my next investment decision with a much more current set of information. That flexibility is really valuable to me. I'm not trying to make a 5-year prediction about where interest rates are going to be. I'm looking at a shorter term horizon and giving myself the opportunity to continually reassess the market every time I get my capital back. That also affects how conservatively I want to underwrite the collateral. If rates are moving higher, I may adjust my ARV assumptions downward. If the market changes, I want my underwriting to change with it. That is one of the reasons shorter duration private lending can be appealing in an environment where there's a lot of uncertainty around interest rates. Now, I don't want you to hear all of this and think, okay, interest rates may go higher, so I should stop investing in real estate. That's certainly one option, but I think there's another way to look at it. Higher interest rates can create opportunities. Whether other investors can't get their financing to work, you may be able to find opportunities through creative financing. When sellers have difficulty finding buyers, they may become more open to seller financing. When traditional lenders become more conservative, private capital can become more valuable. And when other investors are sitting on the sidelines, there may be less competition for the right deals. The key is making sure the deal works under the conditions you're actually facing. You can't control the Fed, you can't control mortgage rates, you have no idea what the actual future is going to look like. You can't control inflation, but you can control what you pay for a property right now. You can control how you structure a deal. You can control how you conservatively underwrite it. And you can control the amount of risk that you're willing to take. There's one other thing that I want to clarify because I hear this confusion all of the time. The Fed doesn't directly set mortgage rates. The Fed controls its short-term policy rate, and mortgage rates are influenced heavily by longer-term bond yields, inflation expectations, economic conditions, and what the market expects the Fed to do in the future. And that's important right now because even while the Fed has been holding its policy rate steady, longer-term Treasury yields have been moving significantly. JP Morgan's recent analysis specifically highlighted that the 30-year Treasury reached its highest level since 2007. So if you're waiting for the Fed to cut rates because you expect mortgage rates to immediately drop, there's a lot more to the story, and that's unlikely to happen. As a real estate investor, I want to pay attention to the entire interest rate environment. So what am I watching over the next several months? Well, there's a few things. First, inflation. Does inflation continue to move higher or does it start to cool? Second, employment. Was the weak July jobs report a temporary blip, or are we seeing a meaningful change in the labor market? Third, energy prices, because higher energy costs can create additional inflationary pressure. Fourth, Treasury yields and mortgage rates. I want to know what the actual cost of capital is doing. And finally, I'm watching real estate fundamentals. What are properties actually selling for? How long are they sitting on the market? Are sellers becoming more motivated? Are rents continuing to support valuations? And most importantly, can I still make the deal work at today's numbers? And ultimately, that's how I think about interest rates as a real estate investor. I don't know what the Fed is going to do in September, and honestly, neither does anyone else. We can make predictions based on the data that we have today, but the next inflation report, the next jobs report, or some completely unexpected economic event could change that picture. So instead of trying to predict exactly where rates are going, I try to structure my investments so I can adapt as the market changes. That's one reason I like shorter term private lending. I can make a loan today, get my capital back in 6 to 12 months, and then reassess the environment before making my next investment decision. And when I'm underwriting these loans, I'm also adjusting my assumptions based on the interest rate environment and what's currently going on. If rates are higher, I'm going to be more conservative with what my expectations are for the properties after repair value. I'm going to look closely at the borrower's exit strategy. I'm going to pay attention to loan to value, and I'm going to make sure that there's enough margin in the deal to withstand some changes. Because I don't want my investment strategy to depend on getting the perfect interest rate environment. I'm trying to build an investment strategy that can adapt to the interest rate environment we're actually in. So, I'm curious, are interest rates changing the way that you're investing in real estate right now? Are you buying? Are you waiting? Are you looking for creative financing? Or are you looking at private lending as a way to participate in real estate without actually owning and managing the property? I know I'm doing that. Let me know in the comments. I'd love to hear what you're seeing in your market. And if you're a W-2 professional who wants to learn how to build wealth through real estate without making it your second full-time job, make sure you subscribe. That's exactly what we talk about here. I'll see you in the next video.